Hello and welcome to the Advanced Projections Economic Report for March of 2023. We've had quite an interesting month so far. Here's our reviews of the economic data highlights for February and early March of 2023. Employment figures for February came in with another fairly high new jobs figure, up 311,000. And unemployment wiggled a little bit, moving up to 3.6%. We still expect that unemployment should eventually begin to move gradually upwards because at these low levels, the Fed must stay fully focused on inflation, given this fresh ammunition for further rate increases. Employment is a lagging indicator in the business cycle, so it typically declines after a downturn has begun. Annual CPI inflation through February was announced on March 14th with consensus expectations for it to be around 6%, and the actual reported value was exactly that, 6%. However, sticky inflation, less food and energy, continued higher in February at 6.6%, still higher than the more general CPI number. The Federal Reserve added another 25 basis point increase to their Fed funds on February 1st. We had expected them to implement a 50-point increase, and new inflation and employment numbers may make them go there on March 22nd. In mid-December, they issued new projections for 2023 through 2025, and they were looking for a longer fight against inflation with higher rates than they projected previously a year before. The hot employment picture seems to confirm that scenario. Look for a repeat of this kind of admission of underestimation on their part when the new report and dot plot comes out at the end of this month, March. Equities prices have gained as much as 10% since the October lows were put in last year, but recently tested key resistance levels, and volatility indices are pointing at another move downward. The S&P 500 has tested overhead resistance around 4,100, where it briefly crossed above its 200-day moving average. The bond markets revealed that smart money is paying more attention to the Fed's signals and pronouncements, which reflected in the S&P 500 dropping around 100 points during February. New jobs reports and inflation numbers reported in March threw cold water on equities, so markets declined further in the first 2 weeks of March, with the S&P losing another 100 points in the first half of the month. Failures of shakier financial institutions are beginning to pop up, as always happens just before and during recessions. Silicon Valley Bank and Signature Bank of New York are just two of several examples. Plus, do not discount the spectacular collapse of FTX a short while ago as well. Our indicator system keeps our recession risk level at 90% plus due to more steeply declining leading economic indicators, continuing hawkish Federal Reserve monetary policy statements, and an ever-deepening red APYC yield curve indicator. There are now no AP indicators showing green, and only one, the AP stock market indicator, is just skirting the boundary between red and yellow. 1 year ago, in early February of 2022, advanced projections gave an extreme risk warning for equities as the Fed was preparing to begin their quantitative tightening program in that March. Here, a year later, in March of 2023, there is a continuing evidence of significant moves to cash as reflected in the long-term bond market, as people are realizing the resolve of the Fed in their long-game battle against the inflation dragon. The recent bank failures have driven many more Treasury instrument purchases across the entire range of the yield curve from 1 month to 30 years, as reflected in the lower yields seen in the last few days. This is clearly a flight to safety. Here are the underlying economic details. Year-over-year consumer price index increases, still resolving supply chain issues and very tight labor markets, continue to affect many aspects of the economy. General expectations out just ahead of the February CPI announcement were for 6%, and it came in at exactly that. The Federal Reserve will not be swayed much by that number, as the underlying sticky inflation numbers are not coming down. Employment, I should say, has not yet turned to a negative trend, and consumers are still spending record amounts on credit. The number of consumer loan delinquencies is now approaching levels seen just ahead of the Great Recession at over 25 million. BLS employment and the Federal Reserve's intentions. Unemployment continues to remain well below 4% over the past year, now 3.6%, with new job gains in February of 311,000. We expect those gains to dwindle in the first few months of this year, or we had expected that, but no evidence of that quite yet. We still do expect to see an accelerating pace of layoffs begin by late spring of 2023. Below is the table showing the employment situation as reported by the BLS, included in our written report. This currently solid employment situation continues to keep the Fed free to be as aggressive as they deem necessary in their rate increase script, as well as in their plans for unwinding their balance sheet, thus decreasing the money supply. They have already stated so, along with their 8 rate increases in the March 22 through February of 23 timeframe, and within their last available FOMC meeting minutes. Look for continued activity in these areas when the Fed returns with their next steps next week at the end of this month. Their December and February rate increases came in 25 basis points below our expectations, but based upon the coincidentally issued report, we do not expect any delicacy or wavering on their part here in the beginning of 2023. Expect at least a 25-point bump in March, perhaps as much as 50 points if they lend more weight to the still climbing credit debt, employment, and sticky inflation values. There's also a table that we have in our written report issued in the Fed's December FOMC report that shows exactly why to continue to expect Fed hawkishness. Note, all their projections made in September have been uprated in December to show higher rates and longer-lasting inflation than they previously thought. Higher rates for longer means more braking on the economy, and they indicate more than a full percentage point higher unemployment from current levels as a consequence. We will update this table next month, as the Fed will issue a new one here at the end of March. In energy, in 2022, the June through November 0.75% interest rate increases had already had a significant effect on the price of oil, driving it down more than 40%. This was in spite of OPEC and Russia recently cooperating in an agreement, both financially and politically motivated, to restore their 2 million barrel a day production cuts to levels which were enforced during the first quarter of 2022. Global demand forecasts now are having an even greater negative impact, with oil very recently moving below $70 per barrel in the past few days. Gasoline prices may yet push north of $4 per gallon during the spring, as a higher than usual number of refineries will enter maintenance shutdown periods. Colorado's main refinery shutdown boosted gasoline prices in that state and regionally. This will probably amplify the normal yearly spring refinery price bump felt around the country, but the decline in crude prices should offset some of the problem. Natural gas prices may end their pricing breather that resulted from a fire at the Freeport, Texas export facility. However, that facility has not fully returned to service, and a warmer than predicted heating season has depressed demand somewhat. Once the Freeport facility returns to full production at the end of March, LNG export activity will be back to near maximum. That may also pressure electric power production costs, as natural gas accounts for about 40% of the U.S. generation mix. Gas prices should soon reflect the expectation for restored export activity, especially if more major winter storm weather hits before the arrival of spring. California, the second largest gas-consuming state, recently experienced record-high natural gas prices at many multiples higher than the rest of the 48 states. Daily consumption recently hit a record high of 140 billion cubic feet per day during their last cold snap. Consumers there reported increases of up to 140% over their costs the previous year. Several new LNG facilities are under construction, and their export activities will keep upward pressure on natural gas prices and hence electricity as well. High natural gas prices have stimulated a renewal in well development, and there are now more drilling rigs in operation than there were in late 2019. On the supply side for natural gas, the exploration industry is beginning to complete wells that were unfinished during 2020 and 2021 and will put them into production over the coming months. The Energy Information Agency has just issued their own projections for declining gas and electricity prices in the near future, but we at Advanced Projections are going to take a wait-and-see attitude before declaring high energy prices to be completely behind us. Fresh negative news in the form of 312,000 new jobs restored the downtrend in equities. The first of what we expect to be several bank failures and identified weaker bank situations, such as Republic Bank, added to market concerns. Confidence-boosting actions have whipsawed the equities markets, increasing volatility. These moves are not likely to temper the Fed's actions to quell inflation, however. We continue to expect significant interest rate increases and then further general declines in equities and bonds in the intermediate term. A return from the current S&P 500 index level just below bubble territory to warm market levels would take that index down to about 3650, and a correction to the mean would be near 3000. In a typical bear market, negative investor emotions carry enough downward momentum to drive indices significantly below the mean towards and through the inevitable retail investor emotions of despair and capitulation when finally the selling ends. There is no current reason to expect anything different this time, as the Fed appears to be highly resolute in their attack on inflation, and that means more significant rate hikes should still be expected, beginning with the next one about a week after the release of this report. They have clearly stated what their targets are, that inflation has not truly begun to respond as needed, and they are dead set against pausing or quitting too early. We have a longer-term chart with actual analyst projections, projected values for S&P 500 earnings and revenue growth from 2017 through 2023. Our markup shows where we think they have miscalculated, similar to what we did for the middle of 2022. The first test for the analysts will be when final fourth quarter earnings are out at the end of March. If they continue to miss expectations en masse, it becomes more certain that 2023 will be weaker than currently expected. However, analysts, of course, like to understate negative expectations. This chart from FactSet shows fourth quarter 2022 earnings for the S&P 500 outside of the energy sector will likely show an aggregate negative growth of about minus 5%, possibly more. Those numbers continue to come forth even as this report is issued, so a much better picture of earnings will be found in our April report. If they show the declines we expect to see, then equity prices should resume their declines as well. We'll provide an updated version of this chart showing the actual results for 2022, including what we expect from the depressed fourth quarter results merged into the full year numbers. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets and for breakdowns in this metric which appear ahead of real economic downturns. The December number, it's always 1 month behind our reporting date for this metric, was up 5.7%. Sorry, that's the January number. The January number was up 5.7%, erasing the previous December monthly decline of 5.8%. Still, risk capital has clearly made some serious exit from the markets. An equity market bottom may be near on a historical basis when margin borrowing declines a full 55% or more from its previous high. So there is still the potential for a further decline of $750 to $800 billion to reach that point. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.